In this lesson, we're going to explore Fibonacci Retracements, a powerful tool that traders use to identify potential support and resistance levels. By the end of this lesson, you'll understand how to apply Fibonacci Retracements to your trading strategy and use them to anticipate potential market reversals. Let's get started. So what exactly are Fibonacci Retracements? This tool is based on the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones, which is closely related to natural patterns found in the world. In trading, Fibonacci retracements are used to identify potential levels where an asset's price might reverse or pause during a trend. The key levels used in Fibonacci retracements are 23.6%, 38.2%, 50%, 61.8%, and 78.6%. These levels are derived from the Fibonacci sequence and represent potential areas of support or resistance where the price might pull back before continuing in the direction of the trend. Let's go through how to draw Fibonacci retracements on a price chart. It's a simple process that can provide you with valuable insights. First, identify a significant price move, either an uptrend or a downtrend. You'll want to draw the Fibonacci retracement levels from the start of the move to the end of the move. In an uptrend, you'll draw the retracement from the swing low to the swing high. In a downtrend, draw it from the swing high to the swing low. The retracement levels will automatically appear on the chart. Now that you know how to draw Fibonacci retracements, let's talk about how to interpret these levels. Here are a few key points to keep in mind. 1. 38.2% and 61.8% levels. These are the most commonly watched levels. If the price pulls back to these levels and holds, it could signal that the trend is likely to continue. 2. 50% level. While not technically a Fibonacci number, the 50% retracement level is often used by traders as a significant point of interest, representing a potential halfway reversal point. 3. Support and resistance. In an uptrend, the Fibonacci levels act as potential support zones. In a downtrend, they act as potential resistance zones. When the price respects these levels, it can indicate that the retracement is over and the trend is ready to resume. So, how can you incorporate Fibonacci retracements into your trading strategy? Here are some practical tips. 1. Use in combination with other indicators. To improve the accuracy of your trades, combine Fibonacci retracement levels with other indicators like moving averages, RSI, or MACD. This can help confirm potential reversals. 2. Set entry and exit points. Use Fibonacci levels to determine your entry and exit points. For example, if the price pulls back to the 61.8% level in an uptrend and shows signs of support, this could be a good entry point. 3. Plan your stop loss. Place your stop loss just beyond the next Fibonacci level to manage your risk. For instance, if you're entering at the 50% retracement level, place your stop loss just below the 61.8% level. To sum up, Fibonacci retracements are a valuable tool for identifying potential support and resistance levels during market corrections. By understanding how to draw and interpret these levels, you can enhance your trading strategy and make more informed decisions. Thank you for joining me today. Keep practicing with Fibonacci retracements and don't hesitate to revisit this lesson if you need a refresher. I'll see you in the next lesson where we'll continue building on these concepts.